This is the Ray Lucia Show.
Coming to the best for the answers here.
The one show that helps you make better money moves. The program all about your money, your business, and your life.
You guys talk about a lot of really good information that even I can understand.
Call Ray now at 844-RAY-SHOW, 844-RAY-SHOW. This is the Ray Lucia Show.
Thank you very much. Thank you, and welcome to the one talk show in America that helps you make better money moves. Yes, indeed, it is the program all about your money, your business, and your life. What's more important than that? Not necessarily in that order, of course. Your money, your business, and your life. Johnny Dean in the house. What's the most important thing to you, brother?
Well, I got to say life. You know, it's
better than the alternative.
Well, it is. I mean, what are you going to do? You know, nothing else matters, I suppose. Money used to matter to me a lot more than it does. I mean, it still does. It's just not as, you know, it's not as prevalent in my life. I don't know why. It should be.
It's not in mine either.
10 years from retirement minimum. We'll see how that goes. But it just doesn't take precedence like it used to.
Well, you're hanging with the retirement dude, man. I'll help you out a little bit.
Well, you have been. Well, you know, part of the problem was I was so stingy, you know, 20, 30 years ago when we first started working together, and you had to work me out of that.
I did have to work you out of
just
that.
Every penny, it was just brutal.
Isn't that weird how some people are like that? See, I'm just the exact opposite.
I know
I grew up way poorer than you. Way poorer.
Yeah, we were not rich, but we were fine. We were okay.
No, you were middle class.
Yeah,
we were on the. My dad was in the Navy. My mom was a stay-at-home mom with 5 kids.
You were a Philly kid in that you know, row house or whatever it was.
Well, I was in a row house, as a matter of fact.
Yeah.
And the projects, but most of the time I spent in the projects.
Yeah.
Which the house was about as small as a row house, but it wasn't a row house.
Oh,
it was a rough neighborhood, though. I'll tell you that.
Well, it was. So you learn to survive, and so any little bit of money you have, you just think, hey, there's nothing wrong with this. I'm not going to be stingy with it. I'm going to use it.
On the subject of money, I've got a great show planned for you all today, folks. Bill Miller, remember Bill Miller? He was quoted back in like 2016. This has just been an amazing story because Bill Miller is a guy that we talked about, I don't know, 20 years ago.
Is he the Bond guy? Or
No. Bill Miller's the guy that was on like the front cover of Money Magazine after he had beaten the Standard & Poor's 500 for 15 years in a row.
Oh, yeah, that's right.
And then of course, he fell out of grace, went from like number one to number last, and then turned it around again. And there was a great article that Barry Ritholtz wrote a few years back because I've been studying active share for the last several years. I'll talk a little bit more about that in a minute. Have I spoken with you about active share much?
No, you and I haven't really talked about it at all.
Okay, well then you're going to be learning along with everybody else.
Well, we'll have to define it, of course.
Of course we will. But yeah, you can kind of put two and two together. I know you will. But I just wanted to pull this out of the woodwork because this is really interesting. Bill Miller, the legendary stock picker at Legg Mason. That's who we're going to talk about. Sit back, folks. Relax. It is the Ray program. Yes, then it's a revolution. Oh, well, we tried.
Well, we're mixing it up, you know, and we'll get it all down. We'll get the timing down.
It's a little bit late.
That's okay. That's all right. He's working on it.
I love this guy, Bill Miller, even though so many people got stung by his terrible performance. And most of the people that jumped into his fund jumped in late. And when you jump in late to one of the best funds ever, and they do poorly, you get really upset. In other words, they looked at the Money Magazine article or whatever magazine it was. I really don't remember. And they see, oh, he beat the S&P 15 years in a row. This guy's a genius. Well, they got in the 14th year. And then in the 16th, 17th, 18th, 19th year, he sucked.
Well, I mean, and you know, what did he do differently in years 16, 17, 18, 19?
Nothing. That's the point. So let's talk about this for just a minute. Bill Miller, the legendary stock picker at Legg Mason Capital Management, beat the S&P, as I said, for 15 consecutive years. But he has an intriguing theory about why investors have been abandoning active investments. In other words, what we have learned over the past, decade or so is that literally trillions of dollars have moved from active portfolio management to passive strategies like people buying index funds, right?
Exchange-traded funds, those things.
Here is what Miller had to say about that, and I could not agree any more because he is spot on. Number one, most active investment management is too expensive. Yeah, that's why a lot of them have left. Miller suggests that about 70% of all active managers are really closet indexers because many of them pile into the same stocks as their benchmark. So what is a closet index fund?
A closet index fund or a closet indexer?
Either one or both.
It's somebody who is purportedly actively managing, but they've designed the fund or the portfolios such that they really are just the index.
Yeah, we call that tracking error, and I have a pet peeve about tracking error. It goes way back into the mid-1990s now, when I had a discussion. It was more or less an argument. I sat on a committee. I guess it was some kind of an investment. It really was an investment committee, but I was one of several of the advisors around the country that were part of this committee. And the portfolio managers would come in and explain what they were doing. And I'll never forget this. I remember saying, excuse me, sir, but why is it that you only have like 0.2% in REITs, real estate investment trusts? And he said, well, because when you are tracking the index, you have to stay close to what the index percentage is in REITs, and REITs were like 0.3% or some ridiculously low number. I said, well, frankly, if you believe in real estate investment trusts, as I do, then you're never going to move the needle with a 0.3 allocation or a 2% allocation. It doesn't move the needle. He says, well, our discipline is to have within a 1% tracking error of the index, which means they're going to perform at the index level, one above or one below. But if you're charging 1.5%,
you're going to underperform.
Exactly. So these guys were big-time institutional pension fund managers, billions of dollars, and it's why I didn't stay with them, because they were managing to a tight tracking error.
You're kind of doing them, your clients or whoever, a disservice, are you not? Or am I reading this wrong?
No, I think you absolutely are, but most people don't realize that, because Miller's correct. 70% or so of the managers out there are doing that because they don't want to get caught with this next one. Volatility is the price you pay for performance. You brought up a good point. What did Bill Miller do in his down years? And he had like 4 or 5 really horrible years. What did he do differently to make him such a crappy manager? Did he wake up, take a stupid pill, and then become stupid?
No.
And then it wore off after 4 or 5 years? No, he did the same thing, but it caused more extreme volatility. And we'll get to this with tracking error when we talk about that in a moment. But you will pay for overperformance with more extremes in volatility. This is why we have talked for almost 30 years now on this show about buying and holding. Find a decent manager. It doesn't have to be the best in the country, because you will never find the best money managers in the country. And those that purport that they have the best managers in their hip pocket are probably lying, because they can't look into the future. And even the good ones like Miller from time to time go bad. But if you find a good one that's got a good track record and a high active share and is not a closet indexer, then the chances are over time you will have performance that is respectable. Maybe it won't beat the market every year, maybe it will. But the fact is, by buying and holding and keeping your powder dry, you will ultimately do better.
The key, I think what you said there, is over time. Because in order to hit a certain number or beat a benchmark or whatever it is, occasionally the active manager has to make, I don't want to say bets, but in some cases it is. They've got to go out on a limb a little bit.
He goes out and quotes John Maynard Keynes, I know one of your favorites.
I do like him, actually. Yes. He was a very smart guy.
He was a very, very smart guy. He was kind of a helicopter guy, helicopter with the money guy.
Sure.
But that's okay.
At the federal level, it works great.
Different form of trickle down. John Maynard Keynes, whom I've quoted as well. In fact, I quoted him yesterday.
You did?
I did. Yeah, I'll tell you more about that later.
Oh.
No, it was a legitimate quote. I'm sorry. I'm just teasing you. It was.
Right.
I never met him actually.
You didn't meet him?
No.
Gee, I'm surprised. Although he may have been dead by the time I
He
don't
was
know.
long dead.
Yeah.
Anyway, John Maynard Keynes.
Keynes.
I think they say Keynes or
It is
Keynes. I don't know.
Keynesian, right.
Keynesian,
Yes.
that's right.
Yes.
Famous quote, worldly wisdom teaches that it's better for reputation to fail conventionally than to succeed unconventionally. What's the point here? Job preservation is the reason for closet indexing. These dudes don't want to lose their gig. Stick around. Active Share is next, right here on the Ray Lucia Show. You're not going to want to miss it. talking. Welcome back, folks.
Does it have the wah machine on
Yeah.
it?
Love is in the air.
I thought he might play Lou Rawls' "You'll Never Find."
Oh, I love
thought of
that
it
song.
when
I
he
love
said
Lou
earlier,
Rawls.
"You'll never find an advisor," and I thought
Yeah.
another advisor like mine. But this is good. This works.
What a voice he had.
Yeah.
Oh, man, I
Let
love
it
that.
be
voice.
Lowenbrow. Didn't he do those?
He did the
commercials?
Lowenbrow commercials,
Yeah,
too.
man.
Yeah.
Yeah,
He
he
great
had it
guy.
going.
Miss him a lot.
Oh.
Miss him a lot. Hey, welcome back, folks. This is the Ray Lucia Show, where we talk about your money, your business, and your life. If you're dying to call us, 844-RAY-SHOW. We'll try to get you on board. Got a lot on the docket. Certainly next hour is a lot easier to get a hold of us. 844-729-7469. Emails, though, raylucia.com. RAYLUCIA.com. I talked in our last segment about closet indexing and quoting from Bill Miller. And I left with this, and it's so important. Job preservation is the reason for closet indexing. So once again, for those that just tuned in, money managers, by and large, have had a difficult time beating their respective benchmark. We call that an index, but it's a benchmark. So if somebody is buying large domestic companies, they're usually measured by the Standard & Poor's 500. 500 of the largest domestic companies. Now, if you're tracking error, if you will, if you're tracking the S&P 500 very, very closely, and the index, an unmanaged index, doesn't charge anything, and you're charging 1%, then more than likely, by closet indexing, you're going to underperform that particular index, which is why, of course, we have learned that most active managers underperform. And it's because, based on all these studies, that most of the money managers don't want to deviate too much from the index because they don't want to look like buffoons because they didn't buy Amazon.
Well, because they're afraid that they'll underperform, but then that takes away their chance to outperform.
Yeah, and the quote that actually it's his co-money manager, Samantha McLemore, who was quoted as saying, quote, "Volatility is the price you pay for performance. You want to beat the market? You got to be willing to underperform the market. If you're not willing to do that, then you're probably going to be a closet indexer,
Right.
or you may as well just buy the index."
Which means, by definition, it means that you're going to have to buy. You're going to have time. You got to have time. You cannot do it every single year.
So he does talk a little bit. This is Bill Miller, the famous money manager, about active share. And it reminds me of something I talked about way back in 2013. It was written about, because they came out, actually it was 2009 when I first talked about it. Jeez. And then again, they revised the study in 2013. But two managers, Martin Kremens and Antti Petelhisto, released a study. It was back in 2009, as a matter of fact. How active is your fund manager? And they're talking about a new measure that predicts performance. Now, it's been a little bit controversial on the predict thing, but
Yeah.
they ultimately did conclude that those money managers that had high active share outproduced the index by an amount that I'll look up in the study here momentarily, and I'll be able to tell you, but it was reasonable. Here's what I can find from this study. Quote, "When the authors went one step further and actually measured the performance of active mutual funds segmented by their active share using available data from 1990 to 2003, they found that funds with the highest active share outperformed by 1.13% to 1.15%. Okay, so, but then there was some criticism on how they actually did that.
There was.
Yes, there was. And so they had another firm, AQR, I think were the ones that did the criticism. And when they went back and redid their study, here is what AQR authors found. They did find some outperformance in the highest active share funds after adjusting for benchmarks. Because one of the problems with the first go-around was that because of the size of the companies, they were comparing to the wrong benchmarks, according to AQR. So when they adjust, we can't
all right.
compare a small cap fund to a large cap fund, essentially.
Of course not.
But here's the upshot of all that. After adjusting for benchmarks, the stock picker funds actually outperformed by an average of 2.71% and generated an average of 0.93 alpha.
Okay, now we'll have to explain this.
Okay. Well, the 2.71% is pretty easy.
Well, yes, but the alpha part.
The alpha, when we talk about alpha, it's the margin of benefit that a money manager is bringing to the table over time on a risk-adjusted basis. So after adjusting for risk, they're worth, and fees and all that. This is all net of fees.
Yes, of course.
They're worth about 1% more per year, risk-adjusted.
That's what the alpha is. In other words, if you've gone with the active manager or whatever you're discussing, at the end of a period of time, I should have done 1% better per year.
You did 2.71 in nominal percent,
but
it's not a fair comparison because you took more risk.
Yes, risk adjusted. Yes.
So on a risk adjusted basis, it's still a reasonable thing for you to consider. So, and again, the study, in my opinion, and others, is not totally statistically significant because the time frame, it's like 20 years or whatever it was. Not long enough in my mind to be statistically significant. But in terms of evaluating money managers, such as the Bill Millers and others, I think it is something that every advisor should be put to the test on. In other words, what is the active share? The higher the better. In other words, when we look at how a money manager is managing the portfolio relative to an index, the farther away they are from the index, the more likely it is they will overperform. This is why I said the other day, John, I like concentrated funds. If you want to play the game the way that I wrote about it 15 years ago now, do a little bit of both. You want to index part of your portfolio because you like the idea of broad diversification and hugging close to the index, fine. That should be inexpensive. You shouldn't be paying a money manager to do that. Now, I'm not talking about paying a financial planner. That's a different story. They get paid to do financial planning. Sometimes they charge you an hourly fee, sometimes they charge you a money management fee, but in reality, it is not to do money management, especially if they're closet indexing. So understand what you're paying for. If you're paying for financial planning, I've written a whole piece. I gave it to you this morning. I don't know where it is now. I've written a whole piece. Study after study after study after study says the right financial advisor can add something like 3% per year net of fees. We'll discuss that at a later date. But right now we're talking about active share and how important it is for your advisor to understand that. So if you're going to do a Menza 50-50 kind of allocation, then index half of it and then go for a more concentrated, higher active share portfolio that isn't a closet index portfolio. Okay, John, when we come back, what is your money manager's sell discipline? If they don't have one, they should. Stick around. All right, welcome back, folks. It is the Ray Lucia Show. That would be my bad self, along with Johnny Dean. His bad self's hanging out with us, too. Now, we've been talking about active share and Bill Miller and closet indexing. Johnny, before I move on to sell disciplines, because I think that's really important, you were asking me questions. I just want to make sure that I'm not getting over the heads of a lot of people here.
Yeah, and it can be. We start talking about alpha and all this stuff. I mean, the bottom line is this, that if you're hiring somebody to actively manage your portfolio, you're paying them something, 1%, something like that, to do it. They got to get paid. Well, if I'm going to pay them 1%, I would hope that they would give me at least 1% of value, risk-adjusted value, so that I'm at least getting something for my money. Otherwise, why would I pay somebody if all I got to do is just ride the benchmark? Now, how do I? My question was, well, go ahead. Go ahead.
Let me just because you said risk-adjusted value. So in the Standard & Poor's 500, if your benchmark is a measurement against the Standard & Poor's 500, and you want to have a risk-adjusted performance calculation, the Standard & Poor's 500 has like a standard deviation of 18 or 19.
Yeah.
If a money manager is holding 10% cash, their standard deviation, even if they owned all of the same stocks, would be lower.
Yeah.
So on a risk-adjusted basis, I could underperform by 1% and still deliver to you a better risk-adjusted performance than the Standard & Poor's 500. So this is, once again, a mistake that is made when evaluating money managers, because if the money manager is taking less risk, then you either have to change money managers that will take the same risk as the S&P in order to do the appropriate comparison.
All right. Well, so I guess I'm speaking also more over time. And I had said earlier, we can't measure this on a year-by-year basis.
Yeah, but so many people do.
It's got to be over 10 years. Well, of course, that's the problem. That's the problem. Hey, the S&P did 30% last year. Why did I only do 11?
Exactly.
What am I paying you for?
The other point that I want to make is the point that I made before the break, and that is there's really a money management fee. Those are the people that are picking the stocks. And then there's the financial planner, financial advisor in the mix. And you have to really separate the two. If your financial planner is actually picking the stocks, then I would suggest to you that they're not going to do both of them really well. They might do one well and the other one terrible, or both of them crappy, but it's not very likely. I mean, I'm a classic example of that. I attempted it once upon a time early in my career, and I was a darn good financial advisor, but I did not have the patience nor the discipline to be a stock. Every time I picked a bad stock, I wanted to shoot myself. So I had to get out of that business.
You've got to separate it. You got to have the planning side of the house, then you have to have the execution side, or the
nerds. Those are the nerds.
Right.
People with personalities shouldn't be money managers.
No, they shouldn't. I look at it this way, okay? When you want to build a house, you have an architect. The architect is the planner. The architect tells you, here's how it should be designed. What do you want? Give me your goals. You want a room here, you want 5 bedrooms, you want this, right? That's the planning side. The architect does not go in and start hammering the nails in and figuring out what the proper codes are and how. That's why you hire the builder to do it. The builder goes in. Builder looks at the instructions based on the architect, the planner, and says, yeah, we can do that, or no, we can't do that. The two of them work together, but I don't want my architect going in there with the hammer and nails and the...
And every time the builder screws up, who do you yell at? The architect.
Well, you might yell at the architect, but that may very well be. But you see what I'm saying. You see what I'm saying.
Exactly.
There's a difference between planning and execution.
I was the guy that got yelled at. Until we brought it all in-house, and then you really could talk to the architect directly.
I think you should be able to.
You should be able to.
Absolutely.
So that brings me to my next point, and I saw this the other day, and I said, yes, spot on. Check this out. Fund managers are good buyers, but terrible sellers. And I said to myself, we've always talked about what is your buy discipline and what is your sell discipline if you're evaluating a money manager. And if they don't have a sell discipline, well, let me read from Barry Ritholtz. Money managers know how to buy. What they need to do is learn how to sell. Most of them are terrible at it. That's the stunning conclusion of a research paper published earlier this month If you manage money or have any of your own invested in managed accounts, it's required reading. It goes far beyond the usual underperformance critiques of active management in an attempt to decipher why fund managers are so bad at this critical aspect of investing. The paper's authors make a number of observations about institutional managers, but the most profound and alarming is this: fund managers would be better off, and in some cases much better off, merely selling holdings completely at random. It's
what do they do
fascinating.
instead? Are they not selling? This
well,
is what
no,
I've
they're
heard.
they're selling the wrong stocks.
They're selling the wrong
They're-
stocks.
the research paper, to kind of summarize it from memory, the study went in and said, okay, how good are they at picking higher performing or better performing stocks? And they found excellent. Hiring a money manager, they do all this research to come up with the metrics that they use. They find a stock to buy. But they're terrible when it comes to selling that stock. Oh, the stock has become overvalued. That's a sell signal. It didn't cross through its 200-day moving average. That's a sell signal. All of those sell signals turned out to be pretty much worthless.
Bogus. Yeah.
They did two portfolios. They did a portfolio consisting of all the stocks that the managers sold. These were institutional managers. On average, they had $573 million of assets under management. So they were good mid-sized managers. So they took the sell stocks that these guys had chosen to sell versus the computer went in and randomly picked stocks to sell. And there was significant overperformance in the ones that the computer picked.
So the random selling did better than the...
Did much better. So what's the takeaway from all this? Because this is what our listeners and viewers want to know. And the takeaway is there should be some semblance to their discipline for how they choose stocks, not only to buy, but how they choose stocks to sell. And I'll tell you what my main takeaway from this, I go back to my concentrated portfolio. Usually when a portfolio manager has 20 stocks or so, they're what they call their highest conviction stocks. That's what I love about it. They put their fannies on the line and say, these are the stocks I love. And typically, they're getting paid for not moving a whole lot of money around. And a lot of advisors say, well, I can't really justify charging
if I'm just sitting around
doing nothing. And so they end up doing something which affects performance negatively.
Well, not just with money managers, it's with the average investor.
And with the average investor.
Because the average investor starts to think about it. They say, well, gee, something's happening here. I better do something.
Yeah, so, and I think this discussion today is really, really important for those individuals that are attempting to manage their own money and who are using portfolio managers or mutual funds where they have so many stocks in the portfolio that can't help but be closet indexers.
Being a closet indexer might have saved Bill Miller from the years 16, 17, and 18, but that's not what he did. That's not how he beat the market every year for 15 years.
No, it's absolutely not how. And you might remember way back when we first started this show, one of the Janus funds, I forgot what it was called now, it was their highly concentrated fund, and it just killed the market. They would just beat the pants off of everybody. But then when advisors said, oh, geez, there's only 20 stocks in it, and then it started to go out of favor, of course, when the market crashed, et cetera, et
Which
cetera.
is what it's going to do from time to time.
Everybody kind of gave up on it. Well, here's the good news about guys like Bill Miller and other concentrated managers. They usually don't care. If you're a highly convicted money manager, and I'm talking about
with
high conviction.
There's a distinction.
First of all, that should be respected. If you're a smart person, you've done this for a long time, you've got a great track record. The fact that you go out of favor for a few years should not be a reason to sell, because individuals, and we've learned this from Dalbar, even those individuals who are buying the index at no fee, still way underperform the index itself
Because of behavior?
because of their own faulty behavior. So, and that's, you asked me this morning about the studies that I've quoted from on
Best practices.
best practices.
And behavior management.
Behavior alone added, I believe it was 1.5% per year to your overall rate of return. And that's just having the right behavior.
You can try to manage behavior, you can't always control it.
That's why they call him the bad boy of radio, Johnny Dean. We'll be back. Don't go away.
Work hard,
right, folks, this is the Ray Lucia Show. Glad you're all with us. Johnny Dean in the house with me. Time to do a couple of emails. So what do you say, fellas? Let's hit it.
Hold on, we have to drop the needle.
mail.
There we go. That was not his fault. We sprang it on him way too fast.
I know.
So, he has to change records and flip it over.
I know.
All right, so there you go. By the way, if you want to email us, you can go to
RayLucia.com.
And then there's
Did you forget how to spell my name? After all these years?
R-A-Y, Lucia, isn't it?
You could do that.
Yeah,
That's what I have to,
L-U-C-I-A.
when I talk to my phone,
Yeah.
I have to say Lucia.
Yeah, I
Call
did it once.
Jean Lucia.
Jean Lucia. Yeah. Yeah, that's great.
That's
you
how
need to
she
have
pronounces it.
You need to have the Italian version of your.
Can I put an Italian version on there?
You can.
Really?
Yeah, but you may have to speak more Italian than you know. I don't know.
I think I can. I only know the dirty words.
Well, it might be kind of fun to ask
I don't
Siri
think
about
so,
that.
yeah.
All right, let's get to an email or two. You want to email us, go to raylucia.com, and I think it's Ask Ray
Yeah.
is where it says. Andy, all right? This just came in. Which is the best way for me to help my two kids with a down payment to buy a home? Is it a 401k or something else? Love your show.
Okay, well, thank you, Andy. Well, you've got a lot of options here. Certainly, you can use your home equity if you own a home. You could borrow money out and lend them some money or gift them some money for a down payment. Now, usually, down payments on a first-time home can be pretty low unless they're trying to reduce their own payment. So you probably don't have to dip in too much. If you don't have a home equity, which I used to, say was one of the better things to do, but home equity's not deductible anymore. Remember, home equity lines of credit and second mortgages, unless you're using it to add basis to the house, you cannot deduct that interest anymore. Remember that?
Not anymore. Not anymore. It's too bad.
It is too bad because I used that like 1,000 times over my lifetime.
That's right.
To
We
help
lost
my kids
that
out and so forth. So that one's out. There's a couple other things you can do. You can borrow from your 401k plan. Remember the rules there are you have to pay it back. It's also not deductible. You have to pay it back over a 5-year period, usually with at least quarterly installments, but typically the company just takes the money out of your paycheck every single month. It's got to be a fair market interest rate. As I said, it's not non-deductible. And if you default on it, you're going to get tagged with a nice premature distribution. Some people are actually talking to me today about taking money out of their IRA. Remember this, and a lot of people don't realize this, John, but a parent or a grandparent can take money out of their IRA penalty-free. Usually a grandparent's over 59 and a half, but not always.
Yeah.
They can take money out of their IRA penalty-free up to $10,000. That would be each. So mom and dad can get $20,000 and gift it to you, and they'll have to pay income taxes, but not to have to pay the penalty. If you have an IRA, you could certainly, or if the kid has the IRA, they can take up to $10,000 from a Roth tax-free and from a traditional IRA taxable, but not subject to penalties.
As long as it's the first-time home purchase, and there's a rule on that.
First-time home purchase.
If you haven't owned a home over the last 2 years, I think it is.
Yeah, you could have owned 30 homes.
And you
if
could have been
haven't
renting. Isn't that something?
Yeah.
You could. If you went out and rented for the last couple of years,
I could have a first-time home purchase. Because I've been renting for 2 years. Yeah.
You of all, the people that bought homes and rented them out and done all this other stuff, you could be a first-time home buyer.
When you go into the downsize mode, and I'm glad we're doing this, even though I probably have missed the boat on a couple of pretty decent things I could have bought. But we've rented 2 homes in the last several years, couple of years.
Yeah.
And we would not buy either one of them. One of the neighborhoods we really like. The other neighborhood we think is okay. A little too busy traffic-wise. So, Jeannie and I were just talking about this yesterday. Was it yesterday at lunch? Yeah, it was yesterday. And we were talking about how the area that she really wants to buy in, there's no homes for sale there.
Yeah.
So we were kind of waiting to see if anything comes up. But then she said we were so set on that particular location because it's kind of close to Gianna and close to Nicholas and Adriana and all
These
that.
are the grandkids.
Yeah. But then she said, well, Silver Saddle, which is an area we once lived in many
Way
years
back
ago,
in
but it was too small for us then.
Yeah.
She said, well, those are one-story because we got to have a one-story house.
Are you at that age?
If she hears me, well, I've got this pulled muscle in my leg from having fallen down the stairs about 6 months ago.
You didn't have to say. You could have said from a football injury. No, you had to say you did something dumb.
I re-injured my leg from an old football injury
all right.
when I fell down the freaking stairs. It was dark. I get up early in the morning. I didn't turn the light on because I don't want to disturb anybody.
Gotcha.
And I was in my socks.
Yeah.
And I slipped on I mean, it's a long story. But I had a butt that was black and blue for like 4 months. It was
so
terrible.
You have to do the one story.
She said we're doing the one story.
Well, a lot of people, especially as they get older, they don't know where they want to live, which area of town or the country. They wind up renting for a year.
Yeah.
Let's see how it is.
It does.
It's
make
actually
some
much
sense.
more. It's much more efficient.
All right. Do we have time to do another one?
You
or do
tell
we
me.
BS our way out.
Got a minute and a half.
Quick.
Janet, I'm a sole proprietor.
Oh, stop there. I can't do a sole proprietor in a minute. Sorry. We'll have to do it next hour. No, what is their question? Just we'll tease everybody so they make sure they listen for next hour.
It has to do with, her husband is earning a lot, maxing out the 401k, is upset about taxes. And
I can't do taxes in a minute. She wants to know what she can do as a self-employed individual. Did she say she had employees or didn't have employees?
Well, it was a little long, so I'm going to have to shorten this. I don't see anything about employees off the top. So you want to hold off?
We're going to do that next hour, folks. This is a great tease for everybody tune into this hour. Make sure you tune in the next hour.
Well, what about a Savers credit question? Not enough time?
Well, we don't have a whole minute and a half now. The answer is yes. If they make, it is married or single?
Wife, so this is married.
Okay.
Yes.
Do they make less than 63 grand or whatever?
It's 40 grand or so.
Okay, well, yeah, you can get a Savers credit.
That's for Al.
All right, Big Al, the sportsman's pal.
We got a minute. Yeah. His wife took off work last year to go back to school. Income dropped to around $40,000. Wants to know if he can get a Savers credit.
Oh, he's a smart guy. The answer is you can't get the whole one because you start phasing out. What is it? I forget, 30 some odd $1,000. There's a phase out.
At the start of the phase out?
Yeah, the start of the phase out is anyway.
It's lower than that, I think.
I know that if you're if you're 63 or under, I think you can get a Savers credit.
Well, there may be something there.
Yeah, there will be something there.
We don't talk a lot about the Savers credit. A lot of people don't qualify for it, and those who do oftentimes don't have the money to put aside, to save.
Yeah, well, that's why you go to mom and dad and say, will you gift me a couple of grand so I can put it in an IRA? That's the maximum. You get 50% of whatever you put away into a retirement account.
Yeah.
So up to $1,000
right.
times 2 is still a couple of grand, right?
Well, it's not bad. I mean, it helps any little bit. We're out of time. How about that?
Yeah, okay.
All right.
I guess we'll have to take up the emails next hour.
Okay, sorry.
In the meantime, I hope you enjoyed this show. I certainly did. God bless. Bye-bye.
You're listening to The Ray Lucia Show, bringing you the best in money information, answering questions about your biggest financial challenges, talking about your money, your business, and your life. Ray Lucia is not a registered representative of or affiliated with any securities brokerage or investment advisory firm. The views and opinions expressed by Ray and his guests are not necessarily those of this station or its sponsors and should not be construed as legal, tax, or investment advice. You should always consult with the appropriate advisors before making any financial decisions. Ray is available to take your questions online at raylucia.com.
Forget about it.
This is The Ray Lucia Show.
Coming to the best for the answers here.
The one show that helps you make better money moves. The program all about your money, your business, and your life.
You guys talk about a lot of really good information that even I can understand.
Call Ray now at 844-RAY-SHOW, 844-RAY-SHOW. This is The Ray Lucia Show.
Thank you very much. Thank you, and welcome to the one talk show in America that actually does help you make better money moves. And if you tune in every day, you will get just as smart as John Dean when it comes to this stuff because he's been tuning in for the last 30 years.
I'll tell you, it helps.
It does.
I know I've said this before, but just hanging out and talking about it. And as we go back all
when
these
I first
years,
met you, you said, "What's a mutual?"
it's exactly
fund?"
what I said. It was on our first or second show, and I felt like an idiot because you're talking about ILITs and C corps and all this other stuff, and I didn't get it. And then
Either did
mutual
the
funds,
audience, by the way. That's why we don't talk about ILITs and
they
C
may
corps
not
that much
exactly.
anymore.
Well, that's how I was, and so I said it was something about a mutual fund. I said, "Can I just ask you a dumb question? Yeah, what's a mutual fund?" And what you gave me a little booklet.
Yeah.
You gave me a little white booklet that explained things like CDs and mutual funds, and it was basic
Yeah, but
stuff.
you were just a kid, for crying out loud.
I was
How old were you?
24 or something. 23,
you were
24.
young. You were a young
25.
kid, smart
Yeah.
young kid,
But
nonetheless
hanging out,
young.
as people should, as they watch and listen to this program. If you stay tuned long enough, you're going to learn a whole lot. I can almost guarantee that.
You might learn about this mind blower. Working just 6 more months makes a huge difference. I mean, a huge difference. I brought this up because you were questioning it the other day. So I figured, well, if Johnny Dean is questioning it, then everybody else must be questioning it too, because you question everything. Have you noticed that about you?
Yes, and I'm proud of that.
Yes,
I don't trust it. Question everything you read.
You are a pain in the what.
Don't just take it
sometimes.
at face value. Everybody's got an agenda, but go ahead.
So that, myself included, what's my agenda? Get through this hour without sounding like a buffoon. That's my agenda.
That's a tall order,
It
Ray.
is. The quant, Ron Piccinini, PhD, Director of Product Development at Covism. They call him the quant. And he talks about sequence risk. I want to share what the quant has to say about sequence risk a little bit later. But I want to start with this, John. When you were born might dictate whether or not you will have a successful retirement.
You mean I mistimed my birth date?
When to retire is the decision that people have to make, and they usually make the wrong one. The impact on retirement security and workforce management, a study by the Pew. I'm not going to talk about the workforce part, but I am going to talk about the impact on retirement security. So sit back, folks. Relax.
Well, not yet, because we only got another minute to go. Or did you want people to relax? They can't relax yet. This is just our little tease.
This is our little tease.
Yeah, but you're teasing this. Is what's coming.
So that's
up.
what I'm doing. I'm teasing.
You tried to get through the whole hour without sounding like a buffoon, and you made it about 43 seconds, and you've already done it.
Make sure you stay with us. I also think my tie is a little messed up. There we go. I think it's straight now.
Well, that's all right. The rest of the audience. This is a very select group of people that
true.
are watching us during this first 5 minutes.
Yeah, you folks are exclusive on TV because we haven't invited any of the radio people around. This is why I say if you call me this hour, we'll put you right up because we know you were patiently and maybe painfully sat through the first 6 minutes.
They were
of
waiting
the
because
show.
you said sit back. They were ready to get involved with the show.
I wanted to see if these guys were on the button, and they weren't.
They weren't because they're on the ball. You see, this is what now you're going to have to reset all this.
Oh,
you
I
have
will.
to do it again
It'll be
here
good.
in about
It'll be
2
good.
minutes.
I'm also going to talk about fun with forecasting. I love this because every time early in the year, we start thinking about what all the forecasts were for last year.
Yeah.
Well, some of this is hysterical, and we'll get a chance maybe to
love
talk about this.
I love.
Yeah.
to
Well,
do
wait
that.
till you see what the Bitcoin forecasts
Oh, please,
were.
please.
Oh, yeah, there's some good stuff. So make sure you stay with us. I mean, sit back, relax, enjoy the ride. It's the Ray Lucia Show. What can I say?
I think we'll be back.
This is the Ray Lucia Show,
Coming to the best for the answers here.
the one show that helps you make better money moves. The program all about your money, your business, and your life.
You guys talk about a lot of really good information that even I can understand.
Call Ray now at 844-RAY-SHOW, 844-RAY-SHOW. This is the Ray Lucia Show.
Thank you very much. Thank you, and welcome to the one talk show in America that helps you make better money moves. A really, really big shoe for this hour of Money Power. Johnny Dean in the house. John, we got a lot of ground to cover. There was a great article written by the Quant.
The what now?
The Quant.
Is that like the Flash?
Yeah, kind of. Only
Yeah.
different.
Okay.
Ron Piccinini. He's the PhD that writes about this stuff. They do this thing on Think Advisor between the advisor and the quant. And I always kind of play advisor because that's what I play.
That's your role.
And it's usually pretty good stuff, but I love reading the quant stuff because that's the propeller head stuff. And then my job on this program is to take the propeller head stuff and make it sound simple, right? Isn't
It's
that
not
what I
easy
get
to
paid
do.
to do? Well, I
Yeah.
get paid to do that. You don't have to worry about that. You just have to make me sound good.
Well, what I'll do is when you start to sound like you're not explaining it properly, I can say, "Hold on, Ray." Huh?
Exactly.
That's what
and
I'll
you're
say.
very good at that.
That
by
I
the
can
way.
do.
So we'll get to that. Sequence risk, very, very important in retirement planning. This retirement savings mind blower. There's this. Is he Harvard or Stanford? Yeah, Stanford. Stanford economics professor John Chauvin was interviewed. His students actually did this paper. It was kind of impressive. The Power of Working Longer. And I will hopefully have a chance to talk to you about that. I have discussed it with you, and you didn't totally buy it or believe it, or you were at least shocked by it. Well, I got news for you. I was shocked by it, too.
Well, I want to make sure we get to it.
Okay, we will. And then the fun with forecasting, if we can get to that. I know you love
we got to
this
do
stuff.
that. We got to do that.
But I start today with this. Some of the key factors which impact an individual's decision to retire. In other words, the day that you retire is really, really important. It might even coincide with days like that you were born. If you were born too late, that could have an impact on your retirement plan. Prue did a really good study. I'll talk about it. Sit back, folks. Relax. It is the Ray Revolution.
that seemed about right on the mark.
Yeah, they were good this time.
good.
Very, very good.
Well, we're short-staffed a little bit.
Oh, we are, really?
Yeah, so we have somebody filling in. Adam's back there, or
Oh.
at least we were. There's some bad weather in our area, if you can call it weather, and so some of the staff wasn't able to, get through.
Yeah, people around here, it's like we get a little bit of rain.
They don't know what to
Everybody's
do.
freaked
They don't know
out.
what to do.
In either event, this is really interesting. Study out of the University of Missouri. Their research was based on analysis of the elective retirement decisions of a cohort of pre-retirees tracked by the Health and Retirement Study from 1992 to 2008. Got
Okay.
that so far?
Yeah, 16 years.
What's interesting here is the cohort comprised individuals between the ages of 51 and 61 in 1992. Hence, they were likely to be on the precipice of retirement when they did this particular study, which is, I don't know, pretty recent. All right, so according to the research, after controlling for variables such as age, wealth, and income, some of the factors that have a significant impact on individuals' decisions about when to retire include equity market returns. Makes sense, right?
Going equity market returns up to now?
Yeah, so well, up to the day that they retire.
Within the last couple of years,
yeah,
probably.
well, if they're thinking about retirement, is it better to retire after you've had a nice run up in your equity returns or not? We'll talk about that. And then the retirement of a spouse. How are you influenced when Chris hangs it up? Is Johnny Dean going to think about hanging it up to be with his lovely lady?
Of course. That's the plan.
That influences decisions and the type of retirement plan in which the individual participated. Here's what they had to say. Equity market returns have a pronounced effect on individuals' elective retirement decisions. On average, a 1% increase in the Standard & Poor's 500 index in any given year increases the probability that a pre-retiree will retire during that year by 2.5%. For example, during a year in which the S&P 500 gains 10%, pre-retirees are 25% more likely to retire than in a year in which the S&P was flat. Fascinating.
We're talking about people, obviously, you said pre-retirees, very close to retirement. They were going to go either way.
So you had a really good year in 2017, and you say, I'm going to retire. You do. 2018 hits, and you go, ooh, was I a dummy or what?
Well, this will play into that sequence.
It will definitely plays into the
be talking
sequence
about.
discussion. The retirement status of a spouse is also an important consideration in elective retirement decisions. Pre-retirees with a retired spouse are 2.4 times more likely to retire in any given year than pre-retirees whose spouses are still working. That is certainly true. I recall from back in the day when I did this stuff that they would tell me, well, my wife's going to keep working, but I'm retiring. I'm going to play golf 4 times a week. And I would say, yeah, let's talk a year from now and let's see if this
they
actually
really do.
happened. And invariably, depending on how much money they had, and pretty selfish too, by the way. I thought that was really selfish on the part of the husband.
Why?
Because he's out playing golf, and the wife is still going to work, bringing home some bacon.
Well, what if it's the other way around? What if the wife
still
says,
would be selfish.
I want to quit work, I'm tired of it, you're going to continue to work till 65?
That's exactly the way my wife feels.
Well, I mean, there seems to be an acceptance of that situation.
Yeah, but it's still selfish. I'm agnostic when it comes to selfishness.
You are. Okay, fine.
I
don't see it as selfish. I think it's whatever.
Finally, pre-retirees covered only by defined benefit plans are 1.9 times more likely to retire in any given year than pre-retirees covered only by defined contribution plans.
This means they're going to have some guaranteed income coming in.
Makes sense,
A defined
doesn't
benefit
it?
plan is a pension plan. A defined contribution plan is something like a 401k.
So what that says is if in fact you're in a defined contribution plan, like a 401k plan, and you want the same security as your compadre across town that works for the government, who's got a nice government plan with a COLA, perhaps you should consider your own personal pension plan. I had this conversation just yesterday on the phone with an advisor, because I still do get calls from advisors. And I said, what you really need to do is help your clients put their own personal pension in, because the guy's working with a rollover from an individual who didn't have a defined benefit plan.
You can purchase a pension plan.
You can. Moreover, these factors have a cumulative impact on individuals' retirement timing decisions. For example, the combination of the retirement of a spouse and a recent strong equity market performance will make an individual more likely to retire than if only one of these conditions were true. So this is a study out of the University of Missouri. Do we have time for me to get into the nitty-gritty of this?
You have 2 minutes.
Yeah, probably not, but let me start. Risks posed by retiring after periods of strong equity market performance.
I think I know.
Your eyebrows raised because you think you know, and I think you know too. Because we have this false sense of security when the markets go up. And when they go up for 3 years running, we really start getting our egos, we've got to control how we feel about future performance, because it can be very dangerous.
What if they've been going up for 9 years running?
I would like to save that for the other side of the break, because
That's
this is
perfectly
really
fine.
fascinating stuff. And again, you know me, folks. I try to focus on the academic side of the house so that you make better money moves, better decisions with respect to how you should be managing your dough. But I have to caution you, and John's instincts are very, very good in this area, because when his eyebrows, and they're pretty bushy, although not as bushy as they used to be.
I got them trimmed 2 days ago. I thought that was pretty good.
You had the bushiest eyebrows I've ever
I had
seen.
I
back in
had
the day.
the guy from 60 Minutes, whatever his name was.
Yeah, what was his name? He's dead now.
Yeah. That guy.
Yeah, that guy. But it's interesting. I'll go through the historical probability of a negative 1-year return following 3-year periods in which the average annual return exceeded a certain percentage.
Andy Rooney. Yes.
Yes, it was Andy Rooney. He doesn't even have a little earpiece with somebody doing your research for you.
No, guys, there's nothing there.
I love those shows where the guys, they sound really smart because they got their whole, crackerjack team in the back.
Of course they
giving
do.
them
They're
information.
whispering and telling them what to say.
None of that stuff on this show.
We don't have that. It's
No.
all off the cuff.
It's whatever
See?
we...
Nothing in here, nothing in here, and nothing,
in
here.
there. We'll be back. Don't go away. It's The Ray Show.
when the truth is found to be.
All right, welcome back, folks. This is the Ray Lucia Show. The truth is found on this program, right?
We do our program with grace.
And very slick, I might add.
We are, I was going to say, good for you. Look at you following
Gracie,
along.
oh yeah.
Gracie,
Yeah.
where's she been?
Oh, probably in the hospital.
I don't know where she is. Haven't heard much from her.
I don't know, to be honest with you. Maybe she's taken one pill and it made her smaller.
I don't know. I don't know.
Wasn't
but
that her too? White Rabbit, didn't it?
Yeah, she did White Rabbit. Yeah. Uh-huh. Oh yeah, that was the airplane.
That was it.
You
the
bet.
Jefferson airplane. I got stories about, but we'll save it for the podcast.
Is this somebody you know? Did you meet?
No,
Gretchen,
I never met Gracie Slick.
Gracie Slick?
No, but I do know somebody that left my band to go on tour as the band that was the opening act for them back in New York.
Well, that's stretching
Yeah.
it, but that's not
That's
bad.
really stretching
That's
it.
stretching it, but I would. That's not bad.
He died of an overdose.
Oh no.
Yeah. Terrible
Oh,
story.
All right. Well, anyway.
At least that's what I was told. It could be a total lie because he never called me.
Yeah, but the fact that you believed that it is possible tells
For
me
all
something
these
about this
years,
person.
since I was 19, I believe.
See, you didn't question what you read or heard. You should always
No, because I
question.
wasn't much into academic research.
No, you
back
weren't
then.
at the time. You were into football or whatever it was.
I was into football and music, in
That's
that
right.
order, by the way.
Well, so now we're into money, and you were teasing
Yeah,
before
well,
about this whole
here's
idea
what
of
happens.
retiring at the wrong time or whatever.
People make the wrong decisions on retirement because when you have a great performing stock market, like we've had, and you brought that up, for the last 8-9 years, we've made a lot of money. And it lulls people in this false sense of security that they can retire, probably spend more money than they should, and typically the really good times are followed by some negative years. For example, here's what they say. The probability of a negative year for the Standard & Poor's 500 is higher after periods of stronger performance. For example, the probability of a negative year was nearly twice as high after a 3-year period in which the average annual return for the S&P 500 was 20%, or higher than the 3-year periods in which the average annual return was 10% or higher. So at 10%, you had about a 30% chance that the next year would be a negative. It's 50% more if it's 20% per year.
It's hard to follow, but what that means is that if you had 3 really good years right before you retired, the better those 3 years were, the more likely it was to be a rotten year the first year or two after you retired.
Yeah, and why is that such a big deal? And the reason that's such a big deal is something that you brought up, or somebody brought up, the sequence of returns risk. And the example they used here, which is a pretty easy example to go through, is they said, well, what if you had a 0% return over 10 years? And you got to 0 by having 10% the first year, then 8, 6, 4, 2, 0, then minus 2, 4, 6, 8, 10. The exact opposite, right?
Over 10 years.
Over
so
10
you
years.
average 0.
You average 0%. You started with $1 million, say, and you take $50,000 out per year. So if you had earned that 0% return getting there with a 10, 8, 6, 4, 2, 0, minus 2, 4, 6, 8, 10,
Yes.
at the end of the 10 years, you'd have $530,450 left over.
So you took $500,000 out over those 10 years. Your million was worth $500,000. So
yeah, which would make
that's about
sense
right.
because you earned
you
0%.
nothing. Right.
I mean, because you had a little bit of gain in the early years.
The early years were good.
Yeah.
The last 2 or 3 were rotten.
So then they flipped the rate of return, where you had minus 10, minus 8, minus 6, minus 4, minus 2, and then 0, 2, 4, 6, 8, 10.
On the positive. So in other words, the day I retire, the year I retire, it's down 10%.
Right.
The next year we're down 8%.
And
so
after 10 years, there's only $310,000 left. Yeah. So even if you have stellar performance after that, which you would likely have, by the way, it's extremely hard to take $50,000 inflation adjusted 10 years from now out of a $310,000 portfolio.
Was this inflation adjusted every year?
I
have a feeling it wasn't.
I'd have to look at it. Wasn't.
I have a
inflation
feeling it was
adjusted.
not. And the interesting thing about that is, in both scenarios, you average 0%
That's
along
right.
the way. But the one that had a negative, bad early years in the beginning, taking money out of that declining portfolio, brought they have $200,000 less almost.
Yeah, so we've
years.
got to talk about the takeaway. And this is in the art of real retirement planning. And so many people in the business get it wrong. I'm flying to New Orleans, as you know, next week, and I'm giving this talk, well, amongst other things. I'm actually giving 2 talks, but this one is all about value add. And one of the great value add propositions for financial advisors is to design some kind of a plan. Doesn't have to be mine, although I think mine's pretty darn good, but a plan, a tactic, a strategy that keeps the money invested so that over a certain period of time, not only can you get yourself closer, if you've had this kind of dismal performance, you're closer to a 10-year period that performs way over 0%. You're not going to stay at 0% forever. But more importantly, don't drain your portfolio in those years where the market is going south, because it exacerbates the decline. And that's, I mean, I built my whole career when I was doing this, John, on that strategy, because it works and it's right and it's appropriate.
You can't control the markets. Sometimes you can't control when you retire. It just is forced upon you. But Ray, I got $1 million. I have to live on something. I mean, $1 million is $1 million, a lot of money, but I got to live on something. Are you telling me that I got to take a chunk of that million and take it out of the market?
That's exactly what I'm telling you. And the way that you take it out of the market is also important, as we've discussed on this program. Alternative strategies that don't correlate with the stock and bond markets is one way to do that. If you have money that's invested, I call it alternative income strategies, because I'm more concerned about income than I am growth in retirement. So if I can find a relatively stable investment, albeit probably illiquid, that would return to me a reasonable paycheck each month, then that's going to lower the amount of money I might have to systematically take out of the balance of the portfolio if I'm using the traditional, which I don't, systematic withdrawal strategy.
I was just going to say, you wouldn't use a systematic withdrawal.
I would after a 15-year head start.
15-year head start, but by then, and this gets back into the whole idea of assets, liabilities, time segmentation. This sounds complicated, but it really isn't. It's just having set non-volatile amounts of money to take in for income, which is really that's the crux of retirement. Having enough income, to heck with your portfolio. It doesn't matter what it does. You got to have an income.
Yeah, we talked about that yesterday. I can always replenish my portfolio after I'm dead with some second-to-die insurance
Right. If you're worried about heirs, there are ways to deal with that, but you've got to have an income.
And this is why literally all of the retirement research that's been done has focused some attention on annuitizing income. You can go to the Wharton Financial Institution Center. You can go to Morningstar. You can go to the Retirement Researcher. You can go to Michael Fink. I could name a dozen studies probably off the top of my head. And that's why it's important. But I also emphasize the alternative income bucket as well. Stick around, folks. It's The Ray Show. right, welcome back, folks. This is the Ray Lucia Show. That's me, along with Johnny Dean. If you'd like to call, the phone lines are open. 844-RAY-SHOW. 844-729-7469. Emails at raylucia.com. By the way, you can email me. I get back to you personally. It does take time. I prefer them short, but I'll take them long as well. Many times I'll just email or text the person back, like I'm doing right after the show. I'm calling a fellow back because he, I think he emailed me, it might have been early this morning or late last night, I can't remember. And he's got a complicated situation. I want to talk to him about it.
Well, you make it short, but also give us enough information. There's kind of a happy fine line, happy medium, something like that.
But I take it personally. I really do. I want to make sure that each and every one of you get your questions answered. I don't care how small the account, how big the account. It doesn't matter to me. I don't do this stuff for a living anymore. I do refer people out if you need someone, but basically, if you just want your question answered, just shoot it to me.
Yeah, and by the way, we get into sometimes complicated stuff, but I want to say this. It sounds cliche. There is no dumb question. You know, there's no question that's too simple or anything like that. Remember, when I first started it, I said this on the air, right, that I didn't know. I said, Ray, what's a mutual fund? I mean, I said it like that. I didn't know.
Yeah.
You didn't care. You just answered my question. So,
I've spoken with people that have PhDs that ask questions that could be considered not dumb, because they're not dumb people, but questions that seem basic. But you know what? This is not a simple business. Trying to take something as complicated as what we talk about every day and make it simple, that's where the art comes in.
Well, that's the challenge of doing this stuff, because you need to understand this. And I want people to know, and it's true. You know, we talk about this all the time, where we throw in terms like sequence of returns, even Roth IRAs. We can sometimes forget. We assume that people know it. Not all of them do. A lot of them who watch the show do.
Or they misinterpret. You just said something off the air to me. You said,
right.
Yes. You need to define what you mean by the term annuitized.
You had said that those who have a form of annuitized income.
Yes.
Whatever you had said, and what you meant, and you could explain it, is more in the broad term. Not necessarily, although maybe, not necessarily buying an annuity and annuitizing the contract, which is, for some people, strictly what that is.
A reverse mortgage could give you annuitized income.
A
real estate investment could give you annuitized income. It won't be guaranteed for life like an annuity, but it's still annuitizing capital over time to give you a paycheck.
We have sometimes referred to it as pensionized income. I think that's what Moshe Milevsky had called it at one point, and we sort of adopted that, and that was years ago when we had him on the show. So just to clarify that. It didn't necessarily mean, you know.
I might have to go back to that. I like that, pensionized income, because that's what it is. We were just talking about creating your own pension.
I love it. I've said this too many times, but guaranteed income. It's what I like. I don't care personally about rate of return, although it's nice.
Well, yeah, but when you talk about guaranteed income, you are talking about annuitized.
Exactly.
When I talk about annuitized income, I'm usually not talking
it's not
about
always
an
about
annuity.
No, when you said alternative income and all that stuff, it's generally not guaranteed. Although
I think, to me, and I know the statistics as well as anyone, 50% of your money annuitized in an annuity gives you a higher likelihood of success. But to me, I like the idea of spreading my risk around a little bit more than that, because I do like the potential of, say, low-levered real estate producing pensionized, if you will, income. I know so many people who have been very successful in that arena. I know some that have not, too.
How do you in something like, you may not even want to get into this, but how do you guard against, how do you set up a kind of floor when there's really when there aren't that many guarantees in some of those strategies?
Well, you have to make sure that an individual has enough resources, like emergency funds and so forth, to buy themselves time,
staying power.
Exactly. So when you own real estate, that has to be number one on the list. You know, after you look at leverage, I remember my criteria for buying real estate. Number one, you got to have positive leverage. What are you buying? What cap rate are you buying out? And what rate are you financing at? And if you're finance costs less than your cap rate is, what the income you're getting on an all-cash basis, then you're making money on the money that you're borrowing. But you don't stop there. The other thing that I do, and I do this with Carlos, you know Carlos, all the time, is if we ever, and we haven't looked at a deal in a long time, by the way, because they're all getting really, really close to hanging it up.
Retiring, yes.
Yeah, but we would look back at what happened in the last couple of recessions. How much did rents have to come down, whether it be self-storage or apartments or commercial office? How much did rents have to come down in order to create a break-even scenario so that we weren't having to feed the pig, so to speak? And maybe that's 25%. So I always would factor in how we would do in a 25% recessionary time period. Would we be able to wait it out? Recessions can last a couple of years sometimes, right? So it may take you 4 or 5 years to get back to the same rents from before. That has to be factored into the equation as well, because of exactly what you said. Even though I'm way more aggressive than you, when it comes to real estate, I've also seen people go bankrupt.
Absolutely.
Because they were overweight in real estate. They didn't have the staying power. We know if you hang on to stocks and or real estate long enough, they usually end up being very, very good investments. But if you have to bail out early because you don't have the financial resources to stay in the game, it could be one of the worst things you could do.
It's true of real estate. It's true of stocks, as you said.
Absolutely.
If you're going to need this money in 5 years, it shouldn't be in there in the first place.
Yeah, and if you do that kind of research and you hire, I left the other one out, and that's good property management.
Wow.
I leave it out because my partner's a property manager, so I didn't have to worry about that, and he's one of the best, although he is getting up there in age too. It's why we haven't bought anything in the last several years, because I don't want to put any more strain on them than we need to.
So are you talking maybe about these alternative incomes sort of as a feeder to if you want to put it in a bucket parlance, a feeder into a bucket one?
Yeah, exactly.
It's not really a bucket one, though, is it?
It's not. It's a bucket three.
It's a
a
3A
high
or
risk.
it's
a higher risk investment, whether
Right.
it's real estate or private debt or whatever. There's a certain element of risk. This is why you must look at leverage, because when we got in trouble, when the real estate market got in trouble, 10 years ago, it was, and even back in the 80s, when, we had a massive decline in real estate prices, when I got into the real estate business.
Yeah, nice
actually,
timing.
I was, my timing was good. It was 1988 for me.
Yeah.
But in reality, if you don't have the staying power, you can't play in that game. And my two partners, who have done very, very well, the reason I got into the real estate business is because my one partner, Carlos, he called me because he was going bankrupt. And I said, Carlos, you're one of the smartest guys I know. Why are you going bankrupt? He said, because 100% of my assets were in Texas real estate, and I was worth $14 million one day, and I had a negative net worth the next.
Almost literally.
Yeah, and were it not for all of the rosaries and that he prayed, Carlos is a super religious guy, and the fact that he was very, very fortunate as he looked through the Wall Street Journal one day when he was down to like his last $5,000. Have I told you this story?
I've heard it, once, but it was a long time ago.
So he's down to his last $5,000, and he sees a building for sale in Orange County, which is where he hangs out.
California.
He circles the building, turns the page, and some dude from New York or whatever is looking for a tilt-up building in Orange County, California. He circles that, goes to the buyer and the potential buyer and seller, gets an exclusive listing, one time only. He puts the two together, and within 60 days, he made like $140,000.
So he kind of brokered the whole deal.
He brokered the deal and was back in the game. And that's when he called me and said he wanted to fly me and Jeannie to San Antonio, Texas, to start checking out real estate that he and Bob were literally losing within days.
Yeah.
And we put a couple of deals together, and the rest is sort of history.
Well, and again, this is complicated stuff, and if this goes back to the idea, if you don't have the staying power to do it, if you don't have the wherewithal, you don't have the money to feed it if it happens to go not, and it doesn't always work.
You have to assume
it's
your
not
rents
going
are going to drop by
then
whatever the percentage
exactly.
is.
But if you're not, then you should never consider that.
The other thing that you have to do, and I see these proposals all the time because I'm still on the list. I still get this stuff, like hundreds of them. And when they quote cap rates and they quote cash flow projections and all of that, there's really very few times have I seen a reserve. We reserved 30% of our income. So if we bought an 8 cap, we weren't distributing 8. We were distributing 70% of 8, about 6 probably, somewhere in that ballpark. Because invariably, I can't say it on the air, but stuff happens in real estate and in the stock market. And this is why it's better to be safe than sorry.
That's why we do what we do.
Yep. All right, and what we do next is emails.
Some emails.
All right, and we got a couple in, so stick around, folks. This is the Ray Lucia Show. telling me I'm not going to have country music on this show?
This is
This is
probably
as country
not.
as we get,
yeah.
Elvis?
I'll get into Jerry Reed, who I really love, but he's more
he's
bluegrass
fantastic. Oh, yeah,
country.
Jerry
and
Reed. Oh,
Jerry
love
Reed
that
is
guy.
as country as I get.
But you know, for a young guy, you're really talking old stuff.
Yeah, I know.
But we should throw a few country tunes. There's some decent country songs.
There probably are.
Yeah.
It just doesn't do anything for me. It just is
John,
a little.
like you know how much of our audience are into country.
I understand. Country is the biggest, most popular
I
genre.
love it. I don't know why
if
you don't
wanna
like it.
say
I love country music.
I just can't. I cannot. I don't know. I can't
Well,
tell
it's
you.
because you grew up
I had-
in the
I-
rock era spinning records at a radio station.
Well, we had a farm too. I mean, you would think country music would be big. It just never did anything for me.
Well, the twangy stuff maybe
Well, because
not,
I would
but
hear that, it was the old, I can't even think of their names, but you remember the Tennessee Ernie Ford and those guys who sang with the twang.
That was a little different.
Yeah.
But have you ever been to the Grand Ole Opry?
No, never.
So you need to do that.
I've heard some of the
Have
songs.
you ever been to Nashville?
No,
You
but
need to do it.
I've been to Nashville Airport. I've never been around Nashville.
Well, that doesn't help you.
No, it
I'm
doesn't
talking
help me
about
at all.
going from bar to bar.
I understand,
Where
yeah.
they're doing great music.
It's not going to do anything for me. I can almost guarantee it.
And every cab driver's a starving musician.
Of course they are.
If I were 19, I'd move to Nashville. Get a job driving a cab.
Yeah.
And then performing, on the weekends or something.
Hey, who knows? You know what? Maybe when you're dead, you can go back and relive your life and change things around. I have no idea.
There's only a couple things I would change.
No?
One is my physique.
Physique? It was pretty
Yeah,
good
I'd
at
be
one
6'2".
time.
I'd be 6'2" and like 190.
You made the mistake of being under 6 feet tall.
If I were 6'2" right now, I'd be perfect.
And if pigs could fly and all that other stuff.
All right, let's do some emails. Hit
There
it,
you
fellas.
go.
You've got mail.
Oh, I tell you. Oh, by the way, we didn't get to the predictor stuff.
We're going to do
and
that next week.
We'll
I'm
do that
sorry.
next week, yeah.
We got carried away with our discussion. What can I say? It was good
It was
discussion.
great. It was
Yeah.
great. We'll never get to all the stuff. All right, let's see. This was Janet. This is a tax question. I hope we have time. We may not get to another. Let's see. Janet says, I'm a sole proprietor making $65,000. My husband earns about $200,000, maxes out his 401k. Our taxes are outrageous. She puts 3 exclamation points after that. Okay? What can we do to minimize taxes for 2019?
Oh, boy, oh, boy, oh, boy. A lot of this depends on how old you are and whether or not you have employees and stuff like that. Listen, your husband is basically, locked in. He can do the 401k. He can max out. Now, there are instances where companies will allow a top hat contribution into a 401k. Remember, you can put like $56,000 in total, but it doesn't go in on a deductible basis. And you can do that mega Roth strategy that I've talked about before. Mm-hmm. But that doesn't help you save taxes. It just gives you a bigger Roth IRA someday. So your husband's not going to probably be able to help in the tax department. And I know of no decent tax shelters that exist other than what you can do as a self-employed individual. Now, talking about that, there's a couple of things that can make some sense. First off, at $65,000 of self-employment income, what's 15.3% of 65 grand? About 10 grand? So right off the bat, you've got $10,000 in Social Security and Medicare taxes. So we might be able to address that. In addition, you're probably in the 25-ish% tax bracket. I don't know what state you're in, but let's say a quarter of your $65,000 because it's all marginal to your husband's $200,000. So you're going to pay what's a quarter of $65,000, whatever that number is, 18 grand,
15,
something like
17, something like that.
So between the two, you're 65,000, almost 30,000 of it's going to taxes, or 25,000 of it's going to taxes. So, couple of thoughts here. If you are over the age of, say, 50, all right? If you're over the age of 50 and you've made $65,000 a year for at least the last 3 years, you can probably incorporate your business as a subchapter S corporation, and you can probably do a defined benefit cash balance type of a plan. Hopefully you don't have employees, or at least old employees, and likely be able to put away 50 grand a year, maybe more, maybe all 65 grand. If you're in your 40s, maybe it's $40,000, but it's a lot. And the reason for the corporation is when you do an employer-paid plan, like a cash balance or defined benefit, through a corporation, you don't have to pay the self-employment tax or any FICA on that. It goes in pre-FICA and pre-federal income tax. That's probably the best thing that you can do to save taxes. The FICA will be a savings forever. The income tax is a deferral. You'll pay tax on it later, presumably when you're in a lower tax bracket.
Will that affect ultimately Janet's Social Security benefits?
Yeah, minusculely. Yeah, it's not going to affect that much because she's already paid in. Remember, Social Security is calculated on your 35 highest years of compensation. So it depends on how much in wages and self-employment income, et cetera, she's had and how many years and for how many years she's paid into the system. If, in fact, she only has 30 years, then she'll get maybe 35ths of what the maximum benefit is. But we're talking about, pennies here, dollars, not pennies, but dollars. We're not talking about hundreds of dollars. And saving $10,000 a year in FICA tax for the next 10 years, that's real money. That'll produce significantly more than what her Social Security is. Because remember, her husband's maxed out. He's going to get the maximum Social Security benefit.
Well, sure. He's over the wage base, so 70,000 of his income is he's saving 6.5% on 70 grand of that.
That's correct.
Yeah.
So she, even if she hasn't worked the 35 years, 50% of her husband's benefit may be very close to what her full benefit is, and she may be able to do some tricky things like, take a spousal and then delay taking hers until she's 70. There's all kinds of stuff that can happen.
She will have options, obviously, yes, especially if he's been earning, this much money over the course of a long time. He's got a very large Social Security benefit, as you're saying, which means that his full retirement age benefit is going to be big, which could potentially give her what she needs.
There you go.
So there you go.
All right, that was Janet.
That was Janet. John had a question, but we got 45 seconds.
Well, Janet, email me more of the details, because if you are over 50 and you don't have employees, this is a slam dunk for you. Now you got to find a good pension company and a decent attorney and all that stuff, and you're going to have to spend a little bit of money, a couple G's probably at least, to get all this stuff done. But the savings will come in year after year after year. Johnny, thank you.
Thank you, sir.
I thank the boys back.
Yes, we're all back.
And I thank all of you folks for tuning in to the Ray Lucia Show. Please tell your friends and neighbors that they can tune in and join in the party as well. Now make it a great day. God bless.
You're listening to The Ray Lucia Show, bringing you the best in money information, answering questions about your biggest financial challenges, talking about your money, your business, and your life. Ray Lucia is not a registered representative of or affiliated with any securities brokerage or investment advisory firm. The views and opinions expressed by Ray and his guests are not necessarily those of this station or its sponsors and should not be construed as legal, tax, or investment advice. You should always consult with the appropriate advisors before making any financial decisions. Ray is available to take your questions online at raylucia.com.